If you thought silver was slow, predictable, or permanently capped, forget everything you believed, because what just happened in the financial system may have opened a Pandora's box that cannot be closed, and the consequences for silver prices, especially physical silver in the United States, could be far bigger than most people are prepared for. The phrase Pandora's box is not used lightly here because it describes a moment when a single action releases a chain of events that cannot be reversed. In this case, that action traces back to the Federal Reserve, its policy decisions, and the unintended signals those decisions sent to global markets. For years, the Fed tried to balance inflation, debt, and market stability like a juggler spinning too many plates. Interest rates were pushed to extremes, trillions of dollars were created, and confidence was maintained largely through belief rather than math. Recently, however, something changed. Markets stopped listening to what the Fed said and started reacting to what the Fed was forced to do. That shift in perception is critical, because silver has always been hypersensitive to credibility cracks in monetary policy. To understand why silver is reacting so violently, you have to understand what an all-time high really means in context. An ATH is not just a number on a chart. It represents the point where every seller who previously bought is either in profit or has already sold. Psychologically, resistance disappears. Historically, when silver clears major long-term highs, price discovery begins, and that is when moves become unstable, fast, and emotional. The surprise for many people is not just that silver is pushing to new highs, but that physical silver prices in the US are reportedly trading at levels far above what paper spot prices suggest, with premiums exploding and availability shrinking. This disconnect between paper and physical silver is not new, but it has never been this visible to the average investor. Paper silver, traded through futures contracts and ETFs, can be created in virtually unlimited quantities. Physical silver cannot. It must be mined, refined, transported, and delivered. When confidence in financial intermediaries weakens, demand shifts from promises to possession. Think of it like the difference between a digital photo of food and actual food during a shortage. One looks fine on a screen, the other keeps you alive. When enough people make that distinction at the same time, price mechanisms break down. The Federal Reserve's role in this cannot be overstated. By holding rates too low for too long and then raising them aggressively into a heavily indebted system, the Fed exposed a structural weakness. High rates increase the cost of servicing government debt, corporate debt, and consumer debt. Low rates fuel inflation and asset bubbles. There is no painless option. When the Fed signaled that it may be forced to tolerate higher inflation rather than risk systemic collapse, markets heard a clear message. The purchasing power of the dollar is negotiable. Silver has historically thrived in exactly that environment. Looking back at previous silver cycles helps make sense of what is happening now. In the late 1970s, inflation surged, confidence in the dollar collapsed, and silver went from under $5 an ounce to nearly 50% in a short period. In 2011, following years of quantitative easing after the financial crisis, silver surged again, briefly touching levels that shocked both bulls and skeptics. In both cases, silver lagged for years, frustrating holders before making a sudden vertical move. The pattern is patience, doubt, then disbelief. What is different today is the scale of debt and the speed at which information spreads. Another critical factor is supply. Silver mining is not easily ramped up. Unlike gold, much of the world's silver is produced as a byproduct of mining other metals like copper, lead, and zinc. This means silver supply does not automatically increase when silver prices rise. At the same time, industrial demand for silver continues to grow. Solar panels, electric vehicles, electronics, and medical technologies all require silver for its unmatched conductivity and reliability. This creates a situation where investment demand competes directly with industrial necessity. When both rise together, something has to give. The idea that physical silver in the US could trade at prices equivalent to over $100 an ounce sounds impossible to many people, but only if they assume the system functions normally. In stressed conditions, local shortages, refinery bottlenecks, and retail panic can create price islands where physical metal trades at extreme premiums. This does not mean the global spot price instantly jumps to that level, but it does mean the real-world cost to acquire silver can far exceed what charts show. For anyone who remembers empty store shelves or sudden supply shocks, this concept should not feel foreign. What truly opens Pandora's box is the loss of trust. Trust that inflation is temporary. Trust that debt can be managed. Trust that paper claims can always be converted into real assets. Once that trust erodes, even slightly, behavior changes rapidly. People stop asking what something should be worth and start asking what it will cost tomorrow. Silver is uniquely positioned in that psychological shift because it is affordable enough for the public, yet scarce enough to be overwhelmed by sudden demand. This is why the Fed's actions matter more than its words. Every pause, pivot, or emergency liquidity program reinforces the idea that the system is fragile. Silver does not need hyperinflation to surge. It only needs persistent uncertainty and the sense that monetary authorities are trapped. When that realization spreads, the revaluation of tangible assets can be swift and disorderly. For viewers watching this unfold, the key question is not whether silver will pull back tomorrow or next week. The real question is whether the long-term framework has changed. When an asset breaks decades-long ceilings while physical supply tightens and monetary credibility weakens, history suggests the move is not a fluke. It is a transition. And once that transition begins, the rules that governed the previous range no longer apply. Now the conversation has to move from what triggered this shift to what it actually means as it ripples through markets, institutions, and everyday investors. Because Pandora's box does not just release one outcome, it releases many, often in ways that are not immediately obvious. When silver begins behaving the way it historically does after a long period of suppression, it exposes weaknesses that were hidden when prices were calm. One of the first places this shows up is in volatility, not just in silver itself, but across correlated assets. Volatility is not chaos, it is information. It is the market signaling that old assumptions are being challenged. When silver pushes toward or beyond all-time highs, it forces a reevaluation of what money is supposed to do. For decades, money was treated as something that could be expanded, managed, and engineered without consequence. Low inflation and globalization masked the long-term effects of currency dilution. But as supply chains fractured and debt piled higher, the margin for error disappeared. Silver reacts to this not because it is magical, but because it is honest. It cannot be printed. It cannot be redefined by policy. Its value is discovered through scarcity and demand. This is where the Federal Reserve's dilemma becomes unavoidable. Every attempt to stabilize the system creates a secondary effect that feeds directly into tangible assets. When the Fed tightens, something breaks. When it loosens, purchasing power erodes. There is no neutral setting anymore. Markets understand this, even if official statements try to soften the message. Silver responds to the reality behind the language. That is why rallies driven by monetary stress feel different from rallies driven by simple speculation. They are fueled by protection, not optimism. Another critical layer is how institutional players interact with silver. For years, silver was largely ignored by large funds because it was considered too small, too volatile, and too inconvenient compared to gold. But when silver enters a true price discovery phase, that calculation changes. Even a small reallocation from large pools of capital can overwhelm the available supply. Imagine a swimming pool versus a bathtub. Gold is the pool. Silver is the bathtub. You do not need much water to make it overflow. This dynamic becomes even more pronounced when confidence in financial intermediaries weakens. Exchange-traded products and futures markets work smoothly when participants trust that settlement mechanisms will function without stress. But when demand for physical delivery rises, those systems are tested. This does not require a complete failure to have an impact. Even minor delays, rule changes, or cash settlements instead of metal delivery can push more participants toward physical ownership. That feedback loop tightens the market further. The idea of physical silver trading far above paper prices is not theoretical. It has already happened in smaller episodes. During periods of intense demand, premiums on coins and bars have surged, sometimes doubling or tripling the spot price. These moments are often dismissed as temporary anomalies, but they reveal something deeper. The paper price reflects confidence in the system. The physical price reflects urgency. When urgency spreads, paper prices eventually have to follow, but not before confusion and disbelief dominate the conversation. Historical perspective helps ground this. After silver's 1980 peak, it spent 2 decades in decline and consolidation. Many declared it obsolete. Then, in the early 2000s, as debt and monetary experimentation accelerated, silver began a slow climb that culminated in the 2011 spike. Each cycle was larger in scale and broader in participation. Today's environment dwarfs those periods in terms of debt, derivatives, and interconnected risk. That does not guarantee a specific outcome, but it does suggest that moves, when they come, will not be modest. Another overlooked factor is the psychological impact of round numbers and headlines. When people hear that silver could be trading at triple-digit prices in physical markets, it challenges deeply ingrained perceptions. Silver is supposed to be cheap, accessible, boring. When that narrative breaks, interest expands beyond traditional investors to the general public. That is when demand becomes nonlinear. People do not buy because of charts. They buy because they are afraid of being last. This is also where patience and discipline are tested. Silver does not move in a straight line. Sharp rallies are often followed by brutal pullbacks designed to shake out weak conviction. These pullbacks do not invalidate the larger move. They reinforce it by transferring ownership from impatient hands to stronger ones. Understanding this pattern is crucial because emotional reactions are the most expensive mistakes in volatile markets. For policymakers, silver's rise is an uncomfortable signal. It reflects skepticism toward long-term currency stability. It highlights the limits of control. Historically, authorities respond to this not by addressing the root cause, but by managing perception. Statements are narratives are adjusted. But markets listen to actions, not words. And when actions consistently favor short-term stability over long-term value, tangible assets retain their appeal. The concept of Pandora's box also implies that once opened, it cannot simply be closed again. Even if silver consolidates or corrects, the awareness it has generated does not disappear. New participants have learned lessons about supply, delivery, and the difference between price and cost. That knowledge persists. It changes behavior permanently. In that sense, silver's move is not just about price, but about education through experience. As this process continues, the role of silver in portfolios evolves. It shifts from a speculative trade to a strategic hedge, from an afterthought to a consideration. That transition does not happen overnight, but it accelerates once key psychological thresholds are crossed. And when it does, the demand curve steepens in ways that surprise even seasoned observers. All of this brings us to a critical point. The events unfolding are not isolated. They are connected to debt, policy, trust, and human behavior. Silver is simply the messenger. Ignoring the message does not stop the process. It only delays understanding. And history suggests that the cost of delayed understanding rises sharply once markets move into full price discovery. Again,